Let's first of all start off with just the overall macro market narrative. Is this one you feel can be really affected by the jobs report today, no matter what it says?
Hi, Dom. It's great to see you too. Yes, of course, if the jobs report is very different from what was expected. So if we have a low number or even a negative number, it's hard to believe. Yes, you could have the market be scared that who knows what's going on with the economy. And the economy right now is what's leading the market. It's good news begets good movement in the market. We want the numbers to be reasonably good, GDP to go up, this landing to not start crashing. If the number is way too high, then we're going to worry about whether the Fed will keep lowering interest rates. But that's unlikely. So the backdrop is inflation is coming down. The economy is reasonably strong. We are not in a recession. And we know that interest rates are on the decline. So that's a nice setup for this fourth quarter, which is supposed to be a strong one for earnings.
Sure, seasonally strong for the markets, stronger for earnings. The economic backdrop is okay. All of those things amid lower interest rates should be bullish. My question then, Kari, is the broadening out trade. Does it continue? Should we be focused on value parts of the market, which have been, as of late anyway, doing some outperforming?
Yeah, exactly. And that's why my word of the day was dimension. And dimension refers to the shape and form of an entity. And we think that the dimension of this market really has been shifting outwards. The breadth is shifting. We've seen it over the last quarter. And the S&P has seen the 490 names below the top 10, which sell for under 19 times next year's earnings, have made a move. They were 18 times, now they're 19, but they are still way below 26 times earnings for the top 10, which represent 34% weight of the market. That's come down as we've seen financials, industrials, healthcare, utilities, a real broadening because there is some value in that part of the market. They have to continue to show earnings growth, but it's 490 names versus 10. And that is critical for this market to continue to go higher.
If that is the case, and you need that broadening out to continue, what key parts of the market, are they value or growth? What key parts are you seeing? What kinds of stocks benefit the most in that kind of a tailwind-ish environment?
Well, Tom, as you know, we're more growth investors. And if the economy is growing, then we believe that growth is really going to continue to carry this trade forward. But it's not as if we're just hyper growth. It can be industrials. It can be names that, I mean, we own a company, Ashtead, I call it industrial. They do rental equipment, and they're going to help the South come out from Hurricane Helene. There are names like Fortive. It's breaking itself up, similar to General Electric, and they do test equipment in healthcare and industrials, all sorts of capital products and technology products. And it can be financials. So there are names like Health Equity. That's a health savings plan company. American Express we like. On the healthcare side, we bought Abbott because their test equipment and devices are really showing growth, and some of the problems they've had over the last couple of years, we feel are going to be minimized this year. So if you're a stock picker, you look for ideas within different sectors. It can be consumer discretionary that has been relatively weak. Even a name like Amazon, we think can benefit from consumers having jobs, spending more, and the retail trade has not been great, but it's starting to pick up.